This checklist is the operational summary of a lifetime of market lessons. To understand the full, epic story behind each step, the painful losses that created them and the epic victories they enabled, the essential pilot's logbook remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. This is not merely a book. It is a deep psychological portrait of a master at work, a chronicle of the very experiences that forged this powerful framework. For those committed to this study, a link to the edition featuring a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, is provided in the description below. The entire process begins not with a stock, not with a chart, but with a broad, sweeping assessment of the entire market. The first and most important step on the checklist is this. Step 1. Assess the general market trend. Before he ever considered buying or selling a single share of any company, Livermore had to have a clear, unwavering conviction about the direction of the primary market current. Was he in a great bull market or a great bear market? This was the foundational question upon which all subsequent decisions would rest. He knew, with the certainty of a man who had been bankrupted by ignoring this very rule, that the big money must necessarily be in the big swing. He was not interested in playing for small, nervous reactions against the primary trend. That was a game for suckers, a certain way to be ground down by commissions and whipsaws. His goal was to identify the great underlying tide, the line of least resistance, and to set his sails in perfect harmony with its powerful, irresistible flow. To fight this trend, he believed, was a form of insanity. He stated it as a simple, almost childishly obvious truth. The thing to do was to be bullish in a bull market and bearish in a bear market. Yet he saw traders violate this principle every single day. They would try to short stocks in a roaring bull market simply because the prices seemed too high, or they would try to buy bargains in the midst of a collapsing bear market, hoping to catch the bottom. These were not acts of courage. They were acts of ego, of a man pitting his own small opinion against the market's gigantic impersonal force. This first step required patience and study. It was not a guess, but a diagnosis based on a careful analysis of general conditions. He would study the money supply, the state of credit, and the health of the nation's key industries. He would observe the market's own behavior, its reaction to news, its ability to absorb selling, or its failure to sustain rallies. He would wait, sometimes for months, until the character of the market was unmistakably clear to him. Only then, with a firm conviction about the primary trend, would he proceed to the next step. With the great strategic direction established, the checklist moves to the next level of filtration. Step 2. Identify the leading industry group. Livermore knew that even in the strongest bull market, not all stocks advance equally. The great power of a primary trend is always concentrated in a few select industry groups. In his day, it was the railroads, then the steels, then the motors. These were the generals, the vanguard that led the entire market army. As they go, he said, so goes the whole market. His rule was to confine his studies and his capital to these prominent leading groups. To spread oneself thin across the entire list, to have an interest in a dozen different sectors, was to invite confusion and mediocrity. It is much easier to watch a few than many, he insisted. By focusing his analytical firepower on the handful of groups that were demonstrating the most profound strength, he dramatically increased his odds of success. He was not looking for a needle in a haystack. He was looking for the most powerful locomotive at the head of the fastest train. The leading group was not a matter of personal preference or fundamental analysis alone. It was a fact, proven by the action of the ticker tape. The leading group was the one that rallied first and strongest after a market correction. It was the one that made new highs with the greatest ease. It was the one that showed the most resilience to selling pressure. Its leadership was a visible, tangible thing to the trained observer. This second step, then, acts as a powerful filter, narrowing the speculator's focus from the entire market down to the single sector where the greatest opportunities reside. The journey of a speculator is often a solitary one, marked by the intense pressure of making high-stakes decisions alone. It is easy to lose perspective, to be swayed by the noise of the crowd, or to falter in your discipline after a series of setbacks. This is why we created this channel, to serve as a constant source of these timeless principles, a place you can return to, not just to learn, but to recalibrate your mindset. If you are committed to the path of a professional speculator, subscribe to our channel and return to these lessons. They are here to provide not just knowledge, but reinforcement and perspective when you need it most. Having identified the market's strongest battalion, the checklist demands an even greater level of specificity. Step 3. Select the leader within the group. This is the final and most critical act of selection. Even within the most powerful industry group, there will always be one or two undisputed champions, the stocks that are moving with the greatest force and conviction, while their peers follow in their wake. The amateur, in his quest for a bargain, will almost always be tempted to buy the laggard, the stock that has not yet moved, believing it is due to catch up. Livermore knew this to be a fatal and fundamental error. A laggard, he understood, is not a bargain. It is a weakling. Its failure to advance in concert with its stronger brethren is a profound sign of internal weakness. There is always a reason for this weakness, a reason that is often invisible to the public until it is too late. The professional does not buy weakness, hoping it will turn to strength. He buys proven, demonstrated strength, and he buys more of it as it becomes stronger. His rule was absolute. Concentrate your fire on the leader of the leaders. The leader is identified by its behavior on the tape. It is the stock that moves first. It is the one that makes the largest percentage gains on the highest volume. It is the one that acts right. It absorbs profit-taking with an ease that is almost contemptuous. It feels strong, vital, and alive. It is the stock that everyone is watching, the one that is making the headlines. To buy this stock, even at what seems like a high price, is not an act of chasing. It is an act of aligning oneself with the market's most powerful, concentrated force. His famous campaign in the steel stocks was a perfect illustration of this principle. He was bullish on the entire group, but he did not buy all the steel stocks equally. He began by testing both U.S. Steel and Utah Copper. From the very first day, U.S. Steel acted like a true leader, moving with power and purpose. Utah Copper, in contrast, was sluggish and unresponsive. Heeding the tape's clear verdict, he concentrated his full financial firepower on the proven leader, U.S. Steel, while leaving the laggard alone. This single, disciplined decision was the key to one of his most profitable campaigns. This third step completes the strategic selection process. The speculator has now moved from a broad assessment of the entire market down to a single high-probability candidate. He has identified the strongest stock in the strongest group in a market whose primary trend is aligned with his intended trade. The odds are now overwhelmingly in his favor. But the checklist is not yet complete. The final, tactical steps of timing, risk, and confirmation still lie ahead, the crucial bridge between a brilliant analysis and a profitable trade. Having completed the first 3 strategic steps of the checklist, the speculator has achieved what few amateurs ever do. He has identified the single most promising candidate for a major move in the entire market. He has filtered the universe of stocks down to the leading stock in the leading group, in a market whose primary trend is aligned with his intended trade. The great probabilities are now on his side, but a brilliant analysis is worthless if it is not matched by a flawless tactical execution. The final 4 steps of the checklist are designed to govern this critical phase, to bridge the vast and treacherous gap between a sound idea and a profitable trade. This brings us to the 4th and perhaps most difficult step of the entire process, a step that tests a man's discipline to its absolute limit. Step 4. Wait for the pivotal point. Jesse Livermore knew that the greatest and most costly mistake in speculation was not being wrong, but being wrong at the wrong time. To be correct in your analysis but premature in your action is to invite a slow and agonizing financial death. You are whipsawed by meaningless fluctuations, your capital is eroded, and your nerve is shattered long before the real profitable move ever begins. He learned this lesson not in theory, but in the brutal reality of his own account statement. He stated, with the pain of experience in his words, after forming a definite opinion with respect to a certain stock, do not be too anxious to get into it. Wait and watch the action of that stock. He knew that a stock, even one destined for a great advance, must first complete its period of quiet, unseen accumulation. To enter during this phase is to have your capital lie dormant and unproductive, or worse, to be shaken out by the deliberate engineered reactions designed to dislodge impatient holders. The professional speculator, therefore, must have the supreme patience to wait for the market's own signal that it is ready to move. This signal for Livermore was the decisive breach of a pivotal point. This was his psychological moment, the point in time and price where the long period of preparation was over and the public marking up phase was about to begin. It was only at this precise juncture, and not a moment sooner, that he would consider committing his capital. The wait might be days or it might be weeks, but the discipline to wait was non-negotiable. With the market finally arriving at the predetermined pivotal point, the checklist moves to the fifth and critically important step of self-preservation. Step 5. Define your risk. Before placing a single order, before a single dollar is put on the line, the professional speculator must answer the most important question of his business. How much am I willing to lose if my judgment is proven wrong? This is not a question to be answered in the heat of battle. It is a cold, calculated decision made in a moment of complete emotional detachment. Livermore treated his capital as a general treats his army's reserves, as a finite and precious resource to be guarded with the utmost seriousness. He wrote, "The speculator has to be his own insurance broker, and the only way he can continue in business is to guard his capital account. The answer to the question of risk, then, is a specific price point, a line in the sand. It is the stop loss, the predetermined point of surrender where the trade is proven to be a mistake and the position must be closed without question or hesitation. To enter a trade without this clearly defined exit point is to engage in a form of financial madness. It is to sail into a hurricane without a rudder, to enter a battle without a plan for retreat. The amateur thinks only of the potential profit. The professional thinks first of the potential loss. By defining his risk beforehand, the speculator transforms a reckless gamble into a calculated business venture. He has controlled the one variable in the entire speculative equation that is completely within his power to control, the size of his own loss. With the trend, the stock, the timing, and the risk all clearly defined, the checklist arrives at the moment of action. Step 6. Execute the initial probe. Even now, with every condition aligned in his favor, Livermore would not charge into the market with his full intended line. He was not a plunger in the reckless sense of the word. His first move was always a test, a small exploratory commitment. He would buy a fraction of his total intended position, perhaps 1/5 or 1/4. This was his final practical question to the market. He had done his analysis, he had waited for his signal, and now he was asking the tape, with his own money, "Am I right?" This method of starting small is a profound principle of risk management. It ensures that if, for some unforeseen reason, his judgment is immediately proven wrong, his loss is kept to an absolute minimum. It is a final cautious step into the water before committing to the full plunge. The amateur in his greed does the opposite. He enters his full position at once, maximizing his risk at the moment of maximum uncertainty. The professional, in his prudence, enters a small position, minimizing his risk until the market has given its final unambiguous confirmation. This brings us to the seventh and final step of the checklist, the market's own answer to the speculator's probe. Step 7. Demand immediate confirmation. This was, for Livermore, the ultimate and most powerful validation of his entire analytical process. A correctly timed trade, made in a true market leader at a genuine pivotal point, should not hesitate. It should, he insisted, show a profit almost immediately. This was not a desire for a quick scalping gain. It was a demand for irrefutable proof that he was in harmony with the market's immediate line of least resistance. He stated it as one of his most foundational beliefs. Experience has proved to me that the real money made in speculating has been in commitments in a stock or commodity showing a profit right from the start. An immediate profit was the sign that other buyers were present, that the upward force was real, and that the path was clear for a sustained advance. It was the market's own green light, the final signal that his campaign could proceed with confidence. If, however, the trade immediately showed a loss, it was a red light, an equally clear signal that his timing was flawed. The market was not ready. There was unseen resistance. To hold on to such a trade was to substitute hope for the clear, factual evidence of the tape. The checklist demanded one course of action: exit immediately. Honor the stop-loss defined in Step 5. Accept the small diagnostic loss and return to a position of cash, waiting for the next, more opportune moment. This 7-step checklist, then, is a complete, holistic system for professional speculation. It is a journey that begins with a broad, strategic assessment of the entire market and ends with a specific, tactical, and confirmed trade. It is a process that forces the speculator to move from opinion to analysis, from analysis to a plan, and from a plan to a disciplined, unemotional execution. It leaves nothing to chance, nothing to hope, and nothing to fear. It is a framework that transforms the market from a casino into a business. Each step is a logical and necessary prerequisite for the one that follows. To skip a step, to act out of sequence, is to break the chain of logic and to reintroduce the element of a gamble. By adhering to this checklist, a speculator ensures that he is always trading with the great probabilities on his side, that his timing is precise, that his risk is controlled, and that his judgment is confirmed by the only authority that matters: the market itself. This was the source of Livermore's power. It was his roadmap to fortune, a guide that is as true and as essential today as it ever was. The path to ruin in the speculative markets is not a sudden, unforeseen catastrophe. It is a slow and methodical process of self-destruction, built upon a foundation of a few simple and eternally repeated mistakes. The average trader believes his failure is a matter of bad luck, of a market that has conspired against him. He does not see that he is not a victim of circumstance, but of his own flawed, undisciplined human nature. Jesse Livermore, a man who walked this path to ruin and back again more times than any other, knew this truth with a chilling certainty. He understood that failure was not an accident, but a choice, a series of incorrect choices, born of the same fundamental errors. His life and his legendary career serve as the ultimate case study in these very mistakes. He was not a man who was immune to error. He was a man who paid a price so high for his blunders that the lessons were burned into his very soul. He learned that to succeed, a speculator must first understand, with brutal honesty, all the ways in which he is likely to fail. He must study his own weaknesses, his own emotional triggers, his own capacity for self-deception. This is not a journey for the faint of heart. It is a deep, unflinching look into the 5 great, expensive mistakes that are the source of all speculative failure. This is not a theoretical exercise. Each of these mistakes cost Jesse Livermore millions of dollars. They are the very errors that are, at this very moment, silently eroding the capital of 99% of all who attempt to play the great game. To understand them is to vaccinate oneself against the most common and lethal diseases of Wall Street. To ignore them is to guarantee that you will, in time, become another one of their countless victims. We will now dissect these mistakes one by one, using the words and the life of the master himself as our guide. The first and most pervasive of all speculative mistakes is impatience, the restless, anxious desire to be in the market at all times. The amateur believes that to be out of the market is to be missing an opportunity. He feels a constant, nagging pressure to be doing something, to have a position, to be in the action. He does not understand that speculation is not a business of constant activity, but of calculated, strategic inaction. Livermore learned at a great and terrible cost that the vast majority of the time the correct position is no position at all. He stated it as a fundamental law. There are times when one should speculate, and just as surely there are times when one should not speculate. The market does not owe a speculator a profit every single day or even every single week. The great fortune-making trends, the high-probability opportunities that are the sole legitimate target of the professional, are rare and episodic. They may only appear a few times a year. The time in between is not for trading. It is for waiting, for studying, for preparing, for allowing the market to set up its next great move. The trader who is consumed by impatience violates this principle. He forces trades where no opportunity exists. He plays for small, meaningless fluctuations, chipping away his capital with 1,000 small cuts of commissions and insignificant losses. He is, in effect, trading out of season. His greatest error is not just the money he loses on these ill-advised trades, but the opportunity he forfeits. When the real, powerful move finally does begin, he is often on the wrong side, his judgment clouded by his recent losses, or his capital is so depleted that he cannot take a meaningful position. Livermore's own history was scarred by this very mistake. He told the story of a time he was profoundly bullish on cotton, his analysis telling him a great advance was inevitable. But the market was not yet ready. It was dull and lifeless. Consumed by his impatience, he could not wait. He jumped in with a large line, and the market did nothing. He was forced to sell at a loss. He repeated this 5 times, his impatience costing him a small fortune. Finally, in disgust, he abandoned the trade. 2 days later, the real move began, a massive, explosive advance that he missed entirely because his patience had finally run out. It was a $1 million lesson in the catastrophic cost of trading when the time is not right. The journey of a speculator is often a solitary one, marked by the intense pressure of making high-stakes decisions alone. It is easy to lose perspective, to be swayed by the noise of the crowd, or to falter in your discipline after a series of setbacks. This is why we created this channel, to serve as a constant source of these timeless principles, a place you can return to not just to learn, but to recalibrate your mindset. If you are committed to the path of a professional speculator, subscribe to our channel and return to these lessons. They are here to provide not just knowledge, but reinforcement and perspective when you need it most. The second great and expensive mistake is averaging down a losing position. This Livermore considered the single most dangerous and unforgivable of all speculative sins. It is a practice born of a toxic combination of hope and ego. A trader buys a stock and it goes against him. The market is telling him with perfect clarity that his judgment was wrong, but his ego cannot accept this verdict. And so he is seduced by the voice of hope which whispers a comforting lie. The stock is cheaper now. It is a better bargain. Buy more and you will lower your average cost. To the amateur, this feels like a shrewd, strategic maneuver. He feels he is taking control of a bad situation. In reality, he is committing financial suicide. Livermore was absolute on this point. Of all speculative blunders, there are few greater than trying to average a losing game. It is to reinforce failure. It is to throw good money after bad. It is to argue with the infallible verdict of the ticker tape. It is a battle that can have only one outcome, the total annihilation of one's capital. He understood the flawed psychology perfectly. The trader is no longer operating on a reasoned analysis of the market, but on a desperate, emotional need to see his original opinion vindicated. He is doubling down not on a sound premise but on a proven mistake. The loss, which was once small and manageable, now begins to grow at an exponential rate. His risk has not been reduced, it has been multiplied. He is now more vulnerable than ever to the very trend that has already proven him wrong. Livermore's own rule was the polar opposite. He never, under any circumstances, added to a losing position. His first loss was always his last, and his best loss. He did, however, with great confidence and aggression, add to his winning positions. He would pyramid his successes, buying more as the price advanced, always on a rising scale. He was reinforcing success, not failure. The trader who averages down is a general sending his best troops into a battle that is already lost. The professional speculator, in contrast, sends his reserves only to the front where the battle is already being won. The third expensive mistake is trusting outside opinions and tips over the verdict of the tape. The amateur speculator is a man who craves certainty in an uncertain world. He does not trust his own judgment, and so he seeks it from others. He listens to the whispers of friends, the confident pronouncements of brokers, and the supposedly secret knowledge of insiders. He is a perpetual tip-taker, a man who has abdicated the difficult and necessary work of his own thinking. Livermore knew this to be a path of certain ruin. He learned through painful and costly experience that even the most well-intentioned advice from the most knowledgeable of sources could be fatal. He recounted the famous story of his trade in Union Pacific at Saratoga. He was long and the stock was acting beautifully, confirming his own reading of the tape. But a close and well-respected friend, a broker with access to the highest circles, advised him with the utmost sincerity to sell. He insisted that the great insiders were unloading the stock. Livermore, in a rare moment of weakness, allowed this friendly, persuasive voice to overrule the clear, objective voice of the tape. He sold his position and even went short. The very next day, the company announced an unprecedented dividend, and the stock exploded upward in one of the most violent advances of the era. It was a costly lesson in the danger of trusting any opinion over the market's own registered facts. An even more devastating experience came from his association with the brilliant Percy Thomas. He allowed the man's magnetic personality and persuasive arguments to convince him to take a massive long position in cotton, directly against his own better judgment and the tape's clear warnings. He was no longer trading his own game. He was trading another man's convictions. The result was his single greatest financial loss, a mistake that cost him millions and nearly drove him from the game for good. From these experiences, he forged an unbreakable rule. Beware of inside information, all inside information. He understood that an insider might tell you when to buy, but he would never, ever tell you when to sell. To do so would be a betrayal of his own interests. The speculator who buys on a tip is a man who has been given a key to a house, but has not been told where the exits are. He is trapped. Livermore's conclusion was absolute. The ticker tape is the only true and reliable insider. Its information is available to all who have the patience and the skill to read its language. It is the only voice a speculator should ever truly trust. Having examined the first three great and expensive mistakes, the sins of impatience, of averaging down, and of misplaced trust, we now arrive at the errors that are born not of inexperience, but of success itself. These are the mistakes that often follow a period of great winning, the traps that are laid by a speculator's own burgeoning confidence and his swelling ego. They are, for this very reason, the most insidious and the most dangerous of all. Jesse Livermore, more than any other, knew the perilous landscape of the victorious mind, and his life offers the most profound warnings against the arrogance that so often precedes a great fall. This brings us to the fourth expensive mistake: betting too big. After a string of successful trades, a speculator begins to feel infallible. The market seems an easy and accommodating thing, a personal ATM from which he can withdraw funds at will. He forgets the cold, hard lessons of his past losses and begins to take liberties with his capital. his sense of caution erodes, replaced by a feeling of invincibility. It is at this very moment of maximum confidence that he is at his most vulnerable. Livermore described this phenomenon with the clarity of a man who had been its victim. He said, "The speculator in such instances loses his sense of balance. The money, having rolled in so rapidly, feels unhealthy. It ceases to be real capital, the lifeblood of a serious business, and instead becomes mere ammunition for a thrilling game. The speculator, intoxicated by his own success, begins to risk a sum on a single trade that is so large it violates all the principles of sound money management. He is no longer a professional speculator. He has become a reckless plunger. The desire to make the market pay for one's luxuries is a particularly dangerous manifestation of this error." Livermore saw it constantly. A trader, flush with victory, would decide that the market should buy him a new automobile or a fine piece of jewelry. This, Livermore knew, was a hoodoo, a certain path to ruin. To trade with a specific desired sum in mind is to abandon all pretense of objective analysis. The trade is no longer a calculated speculation, but an emotional demand placed upon the market, a demand that the market is under no obligation to fulfill. The professional speculator, in contrast, treats his capital with the utmost seriousness. He understood that cash to the speculator is as merchandise on the shelves of the merchant. It is his inventory, the essential tool of his trade. To risk a huge portion of it on one venture, no matter how certain it seems, is an act of terrible business judgment. A wise merchant would never risk his entire inventory on a single customer. A wise speculator must be equally prudent. He must, Livermore insisted, risk only a limited amount of capital on any one venture. Livermore's personal solution to this was a model of discipline. He recounted how, after a particularly successful campaign, he would make it a habit to draw out a large portion of his profits in cash. He would take hundreds of thousands of dollars out of his brokerage account and lock it away in a safe deposit box. He did this because he knew that the only money that is ever taken out of Wall Street by speculators is the money they draw out of their accounts after closing a successful deal. It was a physical act of making his profits real, of protecting them not just from the market, but from himself. This brings us to the fifth and final great mistake, an error that is the very essence of the amateur mindset and the root of so many others: fighting the tape. This is the ultimate act of speculative ego. It is the refusal to accept the market's verdict, the stubborn insistence that your own opinion is more valid than the market's own registered factual action. It is the speculator who, holding a losing position, declares, "The market is wrong and I am right." Livermore knew this to be a form of madness. He operated on a single, unshakable belief that served as his compass in all conditions. Markets are never wrong. Opinions often are. The ticker tape was, for him, the ultimate and only truth. It was the final judge and jury, and its verdict was absolute. To argue with it, to fight it, to hold a position in defiance of its clear message, was not an act of courage. It was an act of pure, unadulterated vanity. The trader who is fighting the tape is a man who cannot admit he has made a mistake. His pride is on the line. He has told his friends, his broker, and himself that a stock is going up, and now that it is going down, he cannot bring himself to accept the humiliating truth. He holds on, his losses mounting, a prisoner of his own initial flawed opinion. He will tell himself, "On the next rally, I'll get out." But when the small, feeble rally comes, his hope is rekindled, and he once again fails to act, only to see the stock plunge to new, more painful lows. Livermore learned to eliminate this self-destructive impulse entirely. He was never wedded to one side of the market. His only allegiance was to being on the right side. The moment the tape told him he was wrong, he did not hesitate, he did not argue, he did not hope. He acted. He closed his position, accepted the small loss, and cleared his mind. He knew that the market is not a personal adversary to be conquered, but an impersonal force to be understood and respected. He likened the trader who fights the tape to a man standing on a railroad track. He told a friend, "If I were walking along a railroad track and saw an express train coming at me 60 miles an hour, I would not be damned fool. Enough not to get off the track and let the train go by. After it had passed, I could always get back on the track again if I desired." This simple, powerful analogy was the core of his philosophy. To stay in a losing position is to stand in front of an express train. The only sane, logical, and professional course of action is to get out of the way. These 5 great and expensive mistakes, then, are the primary causes of all speculative failure. They are the sins of impatience, of hope-fueled recklessness, of misplaced trust, of arrogant overconfidence, and of stubborn, ego-driven defiance. They are not external market forces, but internal psychological flaws. They are the enemy within, the timeless human weaknesses that the successful speculator must, through a lifetime of discipline and self-analysis, learn to conquer. To avoid them is to embrace the path of the professional. It is to trade only when the great opportunities are present. It is to cut every loss without hesitation. It is to trust only the market's own confirmed action. It is to guard your capital as the sacred source of your livelihood. And it is to accept with profound humility that the market is always and eternally the master. This was the great lesson of Jesse Livermore's life, a lesson paid for in millions, a lesson that remains the only true path to survival and to ultimate victory in the great game. To truly understand the mind of the man who learned these lessons, to witness the epic market battles where these principles were forged in the crucible of real-world profit and loss, the essential chronicle remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. This is not merely a book. It is a deep psychological portrait of a master at work, a narrative that gives life and context to every one of these timeless rules. For those committed to this study, a link to the edition featuring a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, is provided in the description below. Ladies and gentlemen, if I am to speak to you tonight, let it not be as a teacher who stands on some pedestal, nor as a prophet with visions of the future, but as a man who has walked through the fire of speculation, been consumed by it, rebuilt from its ashes, and been burned again. What I tell you comes not from books, nor from the tidy theories that fill the heads of professors, but from the brutal, pitiless schooling of the ticker tape and the silent judgment of the market itself. I have known triumph that made me feel invincible, and I have known despair so black that no man could see a way out of it. If my words hold any worth, it is because they were paid for in fortunes won and lost, in sleepless nights and hollow days, in mistakes repeated until they became unbearable truths. When I first walked into a bucket shop as a boy, I saw nothing more than numbers moving on a tape, and yet I understood them as if they were words written in a language that only I could read. The fluctuations spoke to me, and with them came small winnings that grew into larger winnings. Confidence built quickly. Too quickly, perhaps. A boy who finds he can beat the tape thinks himself cleverer than the world. But speculation is a stern tutor, and pride is the first capital it strips away. What comes easily is rarely kept for long. The first lesson I learned, and learned again many times, is that the market is bigger than any man. It will humble you the moment you think you have mastered it. The path was simple at first. Prices move, I follow. When they rise, I buy. When they fall, I sell. It was so clear, so natural, that I could scarcely believe others did not see it the same way. But soon I outgrew the bucket shops, as surely as a snake sheds its skin, and I stepped into the great game on Wall Street itself. There I learned the second truth. The market may be the same in all places, but the stakes are larger, the tricks more elaborate, and the consequences merciless. You cannot treat $1 million market as you would a $50 flutter. Scale changes the very air you breathe. When I tried to play the same way with bigger money, I discovered that the game had changed, and that what had worked for a boy in the shops did not work for a man with the size of capital that moves prices instead of merely following them. The market punished my ignorance as surely as a whip across the back. I lost, and I lost heavily. Yet each loss carved its lesson into me deeper than any book could. I learned that my method must evolve as my capital grew. That to repeat the same play without adjusting for size was folly, and that the larger my stake, the more patience and timing were required. Let me confess something that many traders will not. Losing does not only empty the pocket, it poisons the mind. A man may know all the rules, may even see the truth before him, and yet the memory of his last loss will paralyze his hand when the opportunity presents itself. Fear will whisper, "Remember the pain," and greed will whisper, "This time will be different." And between the two voices a man is torn to pieces. The hardest thing in speculation is not to think correctly, but to act correctly, to act when you must and refrain when you must not, and to do so without the poison of past mistakes clouding your judgment. Discipline is not a word for books, it is the life or death of the trader. And yet, despite the pain, I rose. Time after time, when I had been wiped out, I came back. I studied, I watched, I waited, and when the tide turned in my favor, I struck hard. This is the strange gift of the market. It always offers another chance, but never to the unprepared. There is no sympathy in the market, no forgiveness, but there is opportunity, waiting like a coin on the street for the man who sees it and dares to stoop to pick it up. Many times I made and lost fortunes, and each fortune remade was larger than the last. But do not envy this path. For every rise the fall waited, and every fall struck deeper than the one before. I will tell you something about crowds, for no trader can afford to ignore them. The market is nothing but human nature on display, magnified and multiplied. Hope, fear, greed, panic, these are the forces that move prices far more than earnings or production or politics. A man who can read the crowd, who can sense when the great body of traders leans too far one way or another, has an advantage no calculation can match. But beware, when you trade against the crowd, you must be strong enough to endure being wrong before you are proved right. I have often known I was right in the long run, and yet I was ruined in the short run because my timing was off. Being early is no better than being wrong when your capital runs dry before the market comes around. There were days when the tape sang like music to me, when each movement confirmed my reading, when profits rolled in, and it seemed as though I could not lose. In those days I felt a power that lifted me above other men, a certainty that the market and I were one. And then there were days when the same tape mocked me, when every turn was a trick, and every profit was snatched away before I could claim it. Those days taught me humility, though I often forgot the lesson soon after. Success breeds arrogance, arrogance breeds disaster. Over and over I proved this with my own fortune. It is not enough to know the market. You must know yourself, and knowing yourself is the hardest knowledge of all. There is another enemy, more subtle than fear or greed. It is boredom. The market rewards patience, but patience means waiting, and waiting breeds restlessness. A trader who cannot wait will trade when he should not, will seek action for its own sake, and in doing so will hand his money to the market in exchange for nothing. I, too, have fallen to this weakness. Many of my worst losses came not from great mistakes of judgment, but from the simple inability to sit still when there was nothing to do. A man must learn to wait for the high probability opportunity, and when it comes, to act with all his might. Until then, he must sit like a hunter in the blind, watching, silent, unmoving. Few men can endure such waiting. Fewer still can act with decision when the time comes. But it is the only way. Now let me speak of ruin, for I have known it more than once. To be ruined is not only to lose money, it is to lose reputation, to lose friends, to lose the faith of others and of oneself. It is to walk down the street and feel the eyes of men upon you, knowing they whisper of your fall. It is to sit alone at night and ask yourself if you were ever truly wise, or only lucky, and whether the world has finally unmasked you as a fool. No man escapes ruin without scars, but scars can teach if a man will let them. I learned in ruin what success could never teach me, that nothing is permanent, that the market cares nothing for you, that survival is more important than victory. He who survives can fight another day. He who is destroyed has nothing left but stories. I tell you this, too. The greatest enemy of the trader is his own desire for wealth beyond reason. It is not enough to make a fortune. The mind whispers that it must be doubled, tripled, multiplied without end. The same hand that once trembled with joy at 10,000 will later throw away millions in pursuit of more. I have seen it in myself. I have seen it in others, and it leads always to the same place. A trader who seeks only money will never have enough, and in seeking, he will destroy himself. The true art of speculation is not in making money, but in making correct decisions, in mastering the self, in playing the game with honor against the impersonal forces of the market. The money is but a scorecard, nothing more. And yet, money is power, and power is intoxicating. I confess I was drunk with it more than once. I lived as a king and lost as a beggar, and in both states I was still the same man, chasing the same ghost across the ticker tape. Perhaps that is the true lesson, that the game itself is the attraction, that speculation is not a means to an end, but an end in itself. For if it were only about money, I could have retired after the first great fortune. But I did not, I could not. I returned to the game again and again, as a moth returns to the flame, unable to resist the light even knowing it will burn. Some will hear this and shake their heads, calling me reckless, foolish, addicted. Perhaps they are right. But I tell you this, to have lived without playing the game would have been a lesser life. To have known the market, in all its cruelty and generosity, its beauty and its terror, is to have lived fully. Few men can say they have faced the market and won, even for a time. Fewer still can say they have faced it and lost, and returned to face it again. That is the true courage of the trader, not in victory, but in persistence. If you would take anything from my story, take this: the market is a hard master, but a just one. It pays well to those who respect it, and it destroys utterly those who defy it. Learn patience. Learn discipline. Learn to act without hope and without fear, guided only by the truth of the price before you. Do not trade for excitement, or for vanity, or for greed. Trade because you have read the tape, because the conditions are right, because your judgment is clear and your plan is sound. And when the trade goes against you, as it surely will sometimes, accept it without bitterness, without doubling down in anger, without chasing what is already lost. The market does not care. It moves on indifferent, and only the trader who can do the same will survive. I have given my life to speculation, and it has given me both more and less than I ever imagined. It has lifted me to heights that kings might envy, and cast me down to depths where no man would wish to dwell. It has taught me truths about men, about crowds, about myself, that I could have learned nowhere else. It has broken me and remade me, time and again, until I scarcely know which of me is the true man, the one who won or the one who lost, perhaps both, perhaps neither. But I know this: every tick of the tape is a heartbeat of human nature, and to listen to it is to hear the soul of the market itself. So I leave you with this final thought. Do not seek certainty in the market, for there is none. Do not seek riches beyond measure, for they will not satisfy you. Seek only to play the game well, to survive its storms, to act with discipline, and to accept with humility. When a man begins with small stakes, he imagines that the method which has served him at the outset will serve him forever, only enlarged in proportion. He says to himself, if I can turn a few dollars into hundreds, then I can surely turn hundreds into thousands, and thousands into millions, simply by repeating the same play. But the market is not so simple, and it is not so generous. What works with a small account is often the very thing that will undo you when your stake grows larger. A boy tossing pebbles into a pond may delight at the ripples he makes, but the man who tries to toss boulders will soon find that he has disturbed the whole water. Size changes everything, and the market punishes those who fail to recognize it. With a small stake, a man can dart in and out of the market like a fish, unseen, unnoticed, making his profits on the edges where no one cares about his presence. The bucket shops of my youth were the perfect training ground for such maneuvers. A few shares here, a few shares there. The numbers on the tape scarcely registered my movements. I was invisible, and invisibility is a great advantage to the small speculator. He can make his play and take his profit without leaving a trace. But once the stake grows, once you are no longer a minnow but a whale, the very act of buying or selling changes the situation. You cannot slip in unnoticed. Your orders move prices. Your presence is felt. What once required only speed now requires cunning, patience, and timing of a different order. A boy who makes 100 in a day feels like a genius. He imagines that the same percentage gain on 100,000 is waiting just around the corner. But when he tries it, he discovers that the market is not so accommodating. The liquidity that absorbed his tiny play cannot absorb his larger one without shifting the very price he hopes to capture. He is no longer reacting to the market, he is creating it. This is a different game altogether, and it demands a new method. Yet most men, drunk on their early successes, refuse to change. They believe they can scale up their old tricks and reap fortunes. Instead, they reap ruin. When I first brought real money into the market, I thought I could play as I had always played. I would buy because the tape told me to buy, sell because it told me to sell, and the profits would come as surely as they had before. But I quickly found myself wrong. With size, every misstep grows larger, every hesitation costs more, every error magnifies. A loss that once stung a little now crippled me. Worse, my very size made it harder to reverse course. With a small stake, you can change your mind on a whim, you can sell and walk away, and the market scarcely notices. With a large stake, you cannot unwind so easily. The very act of selling drives the price against you. You are trapped by your own weight. The small trader can be nimble, but the large trader must be deliberate. He must think not only of direction but of timing, not only of the next point or two, but of the broader trend that can absorb his orders without betraying him. He must wait longer for the right setup, because only in those moments of genuine momentum can he place size without immediate resistance. The tape that once spoke in whispers now demands to be read with a different ear, for the signals are the same, but the execution is not. I learned, painfully and repeatedly, that size is the most merciless teacher in speculation. It punishes the hasty, the greedy, and the stubborn with equal cruelty. One of the hardest lessons was that profits could no longer be taken quickly. A small speculator can afford to grab a point here, 2 points there, and be content. A large speculator cannot. The commissions, the slippage, the sheer difficulty of moving size in and out make such small profits meaningless. He must aim for the larger swings, the real movements that justify the risk of putting heavy money to work. This requires patience, a quality that does not come easily to men intoxicated by the action of the market. To sit, to wait, to do nothing until the tide itself moves. This is the discipline that separates those who survive from those who vanish. I had to learn to wait for the big moves, to hold positions for longer than I thought I could, to endure the fluctuations that shook me with fear, because only by capturing the broad market swings could I make my size work in my favor instead of against me. Yet waiting carries its own dangers. A large trader who waits too long, who hesitates at the critical moment, loses not only the profit, but the opportunity itself. The window closes. The crowd rushes in. The move is spent before he even places his order. With a small stake, you can afford such mistakes. For another opportunity always lies just around the corner. With a large stake, missed opportunities are costly, not because they drain the account, but because they weaken the resolve. Doubt grows, frustration builds. The temptation to force a trade, to act simply because nothing has been done for too long, grows unbearable. And that forced trade, made without the clear signal, is often the one that destroys months of careful preparation. I discovered that the very psychology of trading changes with size. A small trader can treat the market as a game, taking his winnings lightly and his losses without much pain. A large trader cannot. Every decision weighs heavily, every fluctuation feels magnified, and the mind itself becomes the greatest obstacle. The fear of losing large sums paralyzes, and the greed for large sums blinds. It is one thing to watch a small position swing against you by a few hundred. It is another to watch a massive position swing against you by millions. The pressure is unbearable to most men, and it breaks them. I have felt that pressure. And I can tell you that it does not make a man wiser, it makes him desperate, unless he has learned iron discipline. The shift from small to large is not only a matter of numbers, it is a transformation of the entire game. With small money, you can think only of yourself. With large money, you must think of the crowd, of liquidity, of the very structure of the market. You must be part trader, part general, planning campaigns instead of raids, thinking in terms of strategy instead of tactics. A raid can win a skirmish, but only strategy can win a campaign. And campaigns require patience, resources, and the willingness to endure setbacks without losing the larger vision. The irony is that many men ruin themselves precisely because they cannot let go of the habits that brought them their first success. They believe that the tape has blessed them with a special gift that the market will bend to them as it did when they were small. They fail to see that the market has changed not because its nature is different, but because their own size has altered their relationship to it. They are no longer students of the tape, they are actors upon its stage. And actors who forget they are no longer in the audience always come to grief. I learned, often too late, that humility must grow in proportion to capital. The larger the stake, the more cautious the trader must become. The small trader can afford to be reckless and recover. The large trader cannot. Recklessness at size is fatal. The larger the position, the fewer the opportunities worth seizing, and the longer the waiting between them. Impatience at small size is forgivable. Impatience at large size is ruinous. The small trader thinks he has conquered the market when he doubles his account. The large trader knows he has only survived another day when he preserves his capital. This is the difference size creates, and it is a difference that most never learn until it is too late. To be right in speculation is not enough. A man may see the truth as clear as the sun at noon. He may know beyond any doubt that the market must turn, that prices cannot hold, that the great swing is inevitable, and yet if he is too early, he is as ruined as the man who was wrong. This is one of the cruelest truths the market teaches, for it mocks the very idea of foresight. Men imagine that the secret is to predict, to know before others what must come. But the market does not reward the first to know. It rewards the one who acts at the moment when the world is ready to agree. To be too soon is to be crushed under the weight of the crowd, even when the crowd is marching toward its own destruction. I have been early more times than I care to count. I have sold stocks at the very beginning of great declines, only to watch them soar further before they finally collapsed. I have bought into the start of great bull markets, only to be shaken out when the rally stalled before its true run began. Each time I was right in the long run, and each time I lost heavily in the short run. My vision did not fail me, but my timing did. And timing is everything when capital is finite. The market can stay wrong longer than you can stay solvent. Those who forget this truth learn it at the cost of their fortune. The crowd is never in a hurry to admit its error. When prices are high and men are giddy with profits, you may see clearly that the end is near. The signs are plain speculation everywhere. Money thrown at worthless stocks, fortunes made overnight. You sell, believing yourself wise, but the crowd has not finished its reverie. They push prices higher still, and each point against you drains your account, until you are forced to cover at a loss. Later, when the collapse comes just as you foresaw, you are no longer in the game. The man who was wrong but stayed with the crowd may even come out better than you, for he rode the last wave of profits while you drowned in your own correctness. This is the paradox of being early. Likewise in a bear market. When prices are beaten down and despair is everywhere, you may see that the tide is about to turn. You buy, confident that the bottom is near, that the great recovery is at hand. But the crowd is not ready to believe. They sell more, driving prices lower. Each new low shakes your confidence, and each margin call forces you closer to ruin. By the time the market finally reverses and races upward, you have been thrown out, a casualty of your own foresight. You were right, but you were too soon, and in speculation that is no better than being wrong. The small trader may shrug at such lessons, for with small size, being early can sometimes be endured. He can hold, he can wait, he can ride out the storm until the market vindicates him. But with size, being early is fatal. The larger the stake. The more pressure each fluctuation brings, the more impossible it becomes to hold through the storm. Size magnifies timing. What might be survivable for a small man becomes deadly for a large one. And so the larger you grow, the more essential it becomes not only to be right, but to be right at the right time. The danger of being early is made worse by pride. A man who sees the truth before others feels a certain arrogance. He believes himself superior, more intelligent, more perceptive. He grows stubborn. He holds to his position because he knows he is right, and in the end he will be proved right. But the market does not pay him for his knowledge, it punishes him for his obstinacy. The tape does not care that he has foreseen the inevitable. It only cares that his position is bleeding, and it will bleed him until he is forced out. I have done this myself, more than once, convinced that my foresight gave me a kind of immunity. It did not. The market stripped me of that illusion as ruthlessly as it strips men of their fortunes. Patience is the antidote to this poison. But patience is hard when you know the truth. To see what must come, and to wait for it is the hardest discipline of all. A man who waits too long risks missing the move altogether, and a man who acts too soon risks being broken before the move arrives. There is no formula for this balance. It is a matter of judgment, of experience, of listening to the tape until it speaks not only of direction but of readiness. The signs are subtle. The market gives hunts when the crowd is about to shift, when the weight of opinion is about to crack. To learn to read these hints is the work of years, and even the best fail as often as they succeed. Consider the difference between the thinker and the trader. The thinker may be proud of being first, of seeing before others what must come. The trader cannot afford such vanity. The trader must be content not to be the first, but to be the one who profits. It is better to be late and right than early and ruined. The trader waits until the market confirms his judgment, until the tape itself shows that the crowd has begun to turn. He does not seek to outsmart the market by hours or days. He seeks to align himself with it at the moment of change. This is not as satisfying to the ego, but it is the only way to survive. I recall times when my judgment told me the market was finished with its rise, that stocks were overvalued, that a crash was certain. I sold, I shorted, I took my stand, and I watched in horror as prices rose day after day, mocking me, bleeding me, until I had no choice but to retreat. Weeks later the crash came, as inevitable as I had known it would, but I was not there to profit. I had wasted my strength fighting the crowd too soon. I had been right, but being right too early is the same as being wrong. The market does not keep score in theories, it keeps score in dollars, and in dollars I had lost. The same happened in reverse. At the end of long declines, when despair covered the land, I would see that the market had reached its bottom. I would buy, and for a moment I would feel clever, courageous, far-sighted. Then the market would break again, dragging me down, forcing me out. Later, when the great rally began, I watched it from the sidelines. My capital too depleted to take advantage. Once more I had been right, but too soon. Once more my correctness was worthless. The discipline required is almost inhuman. To see the truth, to know it, and yet to wait until the crowd confirms it. That is the task. Most men cannot bear it. They act as soon as they know, unable to sit still, unable to endure the torment of inaction. They pay the price for their impatience. The rare man who can wait, who can hold his fire until the exact moment, is the one who profits. The rest are left to boast of how they saw it coming, a poor consolation for an empty account. The irony is that the market often rewards the foolish who simply follow the crowd more than the wise who see ahead of it. The fool rides the last wave of profits before the crash, the last decline before the rally, and by sheer luck of timing he profits where the wise man loses. But this luck is not lasting. The fool will give back his profits in time, while the patient trader, If he can endure the waiting, will harvest again and again. Yet the temptation to act early, to prove oneself smarter than the crowd, remains strong. It is a temptation that has ruined many, myself among them. Being early teaches humility more brutally than being wrong. When you are wrong, you can blame your judgment, your reading of the tape, your analysis. You can adjust, you can learn. But when you are right and still lose, the blow is deeper. It shakes your faith not only in your method, but in the very possibility of success. It makes you doubt whether correctness has any value at all. It is in these moments that traders are most vulnerable to despair, to rashness, to abandoning discipline altogether. And that is the true danger of being early. It does not only take your money, it takes your confidence. And without confidence, a trader is finished before he begins. To guard against this, one must remember that the market is not a place to prove oneself, not a stage for intellect or ego. It is a place to survive and to profit. To survive, one must trade not when he thinks he is right, but when the market shows that he is right. The tape does not lie, but it does not hurry either. It reveals the truth in its own time, not in yours. The trader who cannot wait for that moment will find himself punished, again and again, until either he learns or he is destroyed. There is a difference between losing and being ruined, and a man who speculates long enough comes to understand that distinction in his bones. A loss is an incident, a stumble on the path, an expensive tuition paid to the market in exchange for knowledge. Ruin is something altogether different. Ruin is final. Ruin is the point at which you can no longer play the game. The point at which the market has not only stripped you of money, but of the very means to participate. This is why survival matters more than victory. A man who survives can return tomorrow, next week, next year, and eventually he will find himself on the right side of the great swings. A man who is ruined cannot. He is out of the game, and the market does not remember him. In the beginning, when a trader first tastes the sweetness of profit, he thinks only of winning. He believes victory is all that matters, that to be right is the highest aim. He courts risk recklessly because he imagines himself destined to win more often than he loses. But the market punishes this arrogance without mercy. Even the cleverest trader is wrong often. Even the most disciplined speculator will find himself caught in traps, shaken by fluctuations, betrayed by timing. Victory cannot be guaranteed. What can be guaranteed is that the man who has preserved his capital, who has avoided destruction, will still have the chance to strike when conditions align. That chance is everything. Without it, there is nothing. I have seen men undone, not because they lacked skill or judgment, but because they refused to respect survival. They pressed when they should have waited. They doubled down when they should have cut their losses. They treated the market as if it owed them vindication, as if persistence alone could bend prices to their will. The market does not care. It will drive a man to the poorhouse without a second thought. Survival demands humility. It demands the willingness to admit error quickly, to take the small loss rather than risk the large one. It demands the discipline to stand aside when the tape is unclear, to conserve strength for another day. Victory is tempting, but survival is essential. I remember times when my accounts were high, my fortune immense, and I believed nothing could touch me. At such times, I would take risks that in my early days I would never have dared. The very size of my fortune gave me a false sense of safety. I thought, even if I lose heavily, I have more than enough to withstand it. And yet the market has a way of whittling down even the largest fortune if a man grows careless. Each loss, bearable on its own, leads to the next until the erosion becomes a landslide. It is a rule of profound simplicity, and yet, in its application, it demands the highest levels of discipline. It is a rule that, if followed without deviation, acts as the ultimate shield against catastrophic loss and the ultimate test of a speculator's judgment. It is his number one rule for every single trade. The principle is this: a speculative commitment, if it is correctly timed, must show a profit almost immediately. If it does not, the position must be closed without hesitation, without hope, and without regret. This was not a mere guideline for Livermore, it was an absolute, non-negotiable law. He was not interested in buying a stock and waiting patiently for it to appreciate over months or years. That was the business of the investor. He was a speculator, and the business of the speculator is to profit from moves, correctly anticipated and correctly timed. An immediate profit was the market's own irrefutable confirmation that his timing was correct. An immediate loss was its equally clear verdict that he was wrong. The average trader, however, operates on a completely different and fatally flawed premise. He buys a stock, and if it declines, he holds on. He tells himself it is merely a temporary reaction, that his judgment is sound, and that patience will be rewarded. His capital begins to erode, but he is sustained by the treacherous emotion of hope. He may even be tempted to buy more, to average down his cost, believing he is acting shrewdly. He does not realize that he is violating the single most important rule of the game. He is reinforcing failure, and in doing so, he is paving his own road to ruin. For those who are committed to a deeper, more methodical study of the principles that governed Livermore's legendary career, the essential text remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. It is a book that transcends time, offering profound insights into the unchanging nature of markets and men. We highly recommend the edition that features a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, making its lessons more powerful and accessible than ever before. A link to this essential edition has been provided for you in the description below. Livermore's great rule was born from his understanding of the line of least resistance. He knew that a stock poised for a major move does not hesitate or equivocate. When the time is right, when the underlying forces of accumulation have completed their work, the stock will move, and it will move with purpose and direction. To enter a trade at the precise psychological moment, at the pivotal point where this move begins, is to align oneself with this powerful emerging force. The immediate profit is the tangible evidence of this alignment. It is the market's own way of saying, your judgment is correct. The path is clear. A loss, on the other hand, is a sign of resistance. It is the market telling you that your timing is premature, that there are still significant obstacles in the path of the advance. It may be that there is still a large amount of stock to be distributed by insiders, or that the market is not yet psychologically ready for the move. Whatever the reason, the message is the same. The line of least resistance is not yet in your favor. To remain in the position is to attempt to fight against this resistance, a battle that is both costly and unnecessary. Livermore stated it with the clarity of a man who had paid dearly for the knowledge. Experience has proved to me that the real money made in speculating has been in commitments in a stock or commodity showing a profit right from the start. This was not a casual observation, it was the conclusion of a lifetime of study. He had analyzed his greatest victories and his most devastating defeats, and the pattern was undeniable. His most successful campaigns were the ones that felt right from the very beginning. His most costly errors were almost always the ones where he held on to an initially unsuccessful trade, hoping to turn it around. This rule is, at its core, a ruthless mechanism for eliminating hope from the speculative equation. Hope, as he knew, is the amateur's greatest enemy, the siren's call that keeps him chained to a losing position. By demanding an immediate profit, Livermore gave himself no time for hope to take root. The trade was either right or it was wrong. The verdict was rendered not in days or weeks, but in hours, sometimes in minutes. This brutal, immediate feedback loop prevented him from ever becoming emotionally invested in a mistake. It also connects directly to his most foundational principle of risk management. The first loss is the best loss. By cutting a trade that is not immediately profitable, the speculator is, by definition, taking the smallest possible loss. He is eliminating the problem before it has a chance to grow into a capital-destroying disaster. He is paying a small, acceptable price for the invaluable information that his judgment was at that moment flawed. He preserves his capital, clears his mind, and stands ready to reevaluate the situation from a position of strength, not of desperation. The speculator who violates this rule pays a terrible price, not just in money, but in mental and strategic capital. A losing position held from the start becomes a constant source of anxiety and distraction. It consumes his thoughts, clouds his judgment, and prevents him from seeing other, more promising opportunities that the market is presenting. His capital is tied up in a failing venture, and his mind is imprisoned by the need to see that one trade vindicated. He is no longer scanning the entire market for opportunities. He is staring with desperate focus at a single festering mistake. This is how speculative ventures are allowed to decay into unwilling and often ruinous investments. A man makes a trade intending it as a short-term speculation. It goes against him. But instead of accepting the small loss as his original plan demanded, he decides to hold on, telling himself he has bought a good stock at a fair price and is now an investor. Livermore warned against this explicitly. One should never permit speculative ventures to run into investments. It is an act of self-deception, a way of avoiding the psychological pain of admitting a mistake. The journey of a speculator is often a solitary one, marked by the intense pressure of making high-stakes decisions alone. It is easy to lose perspective, to be swayed by the noise of the crowd, or to falter in your discipline after a series of setbacks. This is why we created this channel, to serve as a constant source of these timeless principles, a place you can return to, not just to learn, but to recalibrate your mindset. If you are committed to the path of a professional speculator, subscribe to our channel and return to these lessons. They are here to provide not just knowledge, but reinforcement and perspective when you need it most. Furthermore, we recognize that the wisdom of the markets is not confined to a single individual. The history of speculation is rich with masters who, while sharing Livermore's core respect for risk, developed their own unique styles. From the mechanical box theory of Nicholas Darvas, to the volume spread analysis of Richard Wyckoff, to the turtle trading system of Richard Dennis, from the deep value principles of Peter Lynch, to the pioneering trend analysis of Charles Dow and the modern psychological insights of Ed Sikota, there is a pantheon of genius to study. To explore this rich history, we have launched a new channel dedicated to the diverse strategies of the world's greatest traders and investors. If you wish to broaden your understanding, the link to this new channel is in the description below. Livermore's #1 rule is not a call for frantic, minute-to-minute trading. The time frame, whether it is 24 hours or 2 days, is less important than the principle. The principle is that the market's reaction to your entry must be favorable and swift. A stock that is truly ready to begin a great advance does not typically linger at the starting gate. It moves. A stock that stagnates, that churns back and forth without making progress, or that immediately yields to selling pressure, is a stock that is advertising its own weakness, or at least its lack of immediate readiness. To follow this rule is to demand that the market proves you right, and proves you right now. It is a shift from a passive, hopeful stance to an active, demanding one. The speculator is not a supplicant, begging the market for a profit. He is a professional, making a calculated commitment and expecting an immediate return on his investment of capital and judgment. If that return is not forthcoming, he withdraws his capital without a second thought and redeploys it elsewhere. He is a manager of probabilities, and a trade that is not immediately profitable is, by definition, a low-probability venture. This rule, then, is the ultimate filter. It is the gatekeeper that stands at the entrance of every trade. It separates the high-probability, correctly timed entries from the premature, hope-fueled gambles. It ensures that the speculator's capital is only ever committed to positions that are in harmony with the market's immediate current. It is the mechanism that enforces the discipline of timing, the foundation upon which all of Livermore's greatest campaigns were built. To adopt it is to take the first and most critical step away from the mindset of the amateur and toward the cold, calculated, and ultimately profitable world of the professional. To understand the profound power of Livermore's #1 rule, one must first understand what he was looking for in those first critical hours and days after entering a trade. The immediate profit was not merely a financial gain, it was a signal, a piece of vital information, a confirmation from the market itself that his timing was correct and his judgment was sound. But what did this confirmation actually look like on the tape? It was not just a single uptick. It was a collection of specific, observable behaviors that, taken together, told him that he was in harmony with the market's true line of least resistance. The first and most important signal of confirmation was the character of the move itself. A stock that is truly ready to begin a great advance does not do so timidly. It moves with force and conviction. When Livermore entered a trade at a pivotal point, he expected to see an immediate and decisive move away from that price level. A stock that churned back and forth, that hesitated and struggled to make progress, was a stock that was advertising its own lack of readiness. It was a sign that there was still significant resistance to be overcome, and to remain in such a position was to invite the unnecessary risk of a sudden reversal. This movement, he observed, should be accompanied by a distinct increase in volume. Volume is the engine of a price move. A breakout on low volume is often suspect, a sign of a lack of broad participation and conviction. But a breakout on a sudden, dramatic surge in activity is a powerful confirmation. It shows that other market participants, the floor traders, the public, and perhaps other informed interests, are seeing the same thing and are acting on it. It is the market's own way of endorsing the move, of providing the fuel necessary for a sustained advance. Another critical sign of confirmation was the ease of execution. When Livermore was correct in his timing, he found that accumulating his line was a relatively straightforward process. If he was buying, he might have to bid the price up slightly, but the stock would be available, and the market would readily absorb his purchases without faltering. This was a sign of a healthy, liquid market with broad underlying demand. The trade felt right because it flowed with the natural current of the market. Conversely, if a trade felt like a struggle from the very beginning, it was a profound danger signal. If, in trying to buy a stock, he found that his own purchases were the only thing holding the price up, that the moment he stopped buying, the price began to sag. This was a clear indication that he was on the wrong side. He was attempting to single-handedly fight a tide of selling pressure. This was not a position of strength, but one of extreme vulnerability. The trade was not acting right, and therefore it had to be abandoned. This same logic applied to the behavior of the stock relative to its group and the overall market. Livermore was a firm believer in following the leaders. He knew that the great market trends do not happen in isolation. They are led by the strongest stocks in the strongest industry groups. Therefore, a critical form of confirmation for any new trade was to see sympathetic movement from its sister stocks. If he bought a leading steel stock at a pivotal point, he wanted to see the other major steel stocks also begin to firm up and advance. This harmonious group action was a sign that a broad, sector-wide move was underway. It was a confirmation that his judgment was not based on an isolated anomaly, but on a powerful, underlying current that was lifting all ships in that group. It provided an immense sense of confidence and security. He was not just in a single, correct trade. He was participating in a great, validated market movement. The absence of this confirmation was an equally powerful warning. If he bought a stock and it advanced, but the other stocks in its group refused to follow or, worse, began to decline, he would grow immediately suspicious. It was a sign that the strength in his stock might be a manipulative move or an isolated, unsustainable flurry of buying. A leader without an army is not a leader. It is a target. He would often sell a position even if it was showing a small profit if its group failed to confirm the move. Ultimately, Livermore's #1 rule was a complete, multifaceted diagnostic tool. The profit he was looking for was not just a green number on his ledger. It was a composite picture of market health. It was a decisive price move, on convincing volume that was easy to execute, that did not look back, and that was confirmed by the sympathetic action of its peers. When all these factors aligned, it was the market's own unambiguous signal that a great and profitable opportunity was at hand. This is what gave him the confidence to sit tight, to pyramid his position, and to ride the great swings for all they were worth. His confidence was not born of ego or hope, but of the accumulated evidence of the market's own behavior. He had a reason, a powerful and validated reason, for his conviction. This is the great psychological benefit of his rule. It replaces the anxiety of uncertainty with the calm confidence of a confirmed diagnosis. For the modern trader, this principle is as true today as it was a century ago. Before you commit your capital, you must demand that the market proves you right. Do not be content with a trade that goes nowhere or immediately goes against you. Do not hold on to a position out of hope. Look for the signs of immediate confirmation. Is the move decisive? Is the volume convincing? Is the stocks group acting in harmony? If these confirmations are absent, you must have the discipline to accept that your timing is wrong. Cut the trade. Take the small loss. Preserve your capital and your mental clarity. There will always be another opportunity, another day, another trade. But that next opportunity is only available to the speculator who has had the wisdom to survive his own inevitable mistakes. This, then, is the ultimate meaning of Livermore's great rule. It is a commitment to trading only the highest probability setups. It is a discipline that forces the speculator to act only when the market's own powerful forces are aligned in his favor. It is a simple but profound method for ensuring that when you are right in a big way, and when you are wrong in a small and insignificant one. It is not just the number one rule for every trade, it is the number one rule for a long and profitable career.